Hello and welcome back to the Geordie Pig Investor channel. Today we are going to look at, is Bank of America stock a buy right now? What is Bank of America? Ticker symbol BAC. Well, if you haven't heard of Bank of America, you must be living under a rock, because it is one of the world's leading financial institutes, serving individuals, small to middle market businesses, large corporations and governments with a full range of banking, investment management and other financial and risk management products and services. The firm's segment include consumer banking, global wealth, investment management, global banking, global markets. Consumer banking segments offer a range of credit, banking and investment products and services to consumers and businesses. Some key stats about Bank of America is it's obviously based over in the United States. It is part of, you guessed it, the banking industry. It has a market cap of over $309 billion. It went public in 1979, has over 200,000 employees, has a current dividend growth streak of 10 years, a big 5-year dividend growth rate of 8.67% and a nice dividend yield at 2.62. Over the last year, Bank of America has performed very well, being up nearly 39%, and we're going to look at today, is this stock a buy right now? Bank of America's earnings call and fundamental analysis. Bank of America reported a net income of $6.9 billion for Q2 2024 with earnings per share at 83 cents. Revenue for the quarter was $5.6 billion, which is up 6% year on year. This is driven by a 14% increase in asset management fees and a 29% rise in investment banking fees. Deposits also grew 2% year on year, which reflects customer loyalty, while digital engagement surged with over 47 million active mobile users. Despite headwinds from higher funding costs, the company expects net interest income to grow from Q2's trough, anticipating to reach approximately $14.5 billion in Q4 by 2024, aided by strategic investments and operational efficiencies. Sales and trading revenues continue to perform well, marking the 9th consecutive quarter of growth, with a 7% increase in the business maintains strong asset management flows, with asset under management growing by $58 billion year on year. The bank executed share repurchases worth $3.5 billion and paid out over $1.9 billion in dividends. Additionally, the bank announced an intent to increase its quarterly dividend by 8%, which is no surprise with their low but healthy payout ratio sitting at only 37%. Key fundamentals for the Bank of America are: it has a positive net income at $22.8 billion, positive ROE at plus 8%, positive revenue growth forecast at plus 5%, has very good short and long-term solvency, has assets increased over 36% in the last 5 years at $3.3 trillion. Okay sides are that the equity increased over 8% in the last 5 years with net $294 billion, has all right debt to equity at 2.38, but it does have negative 1-year revenue growth at negative 2%. Next, we're going to have a little look at the discounted cash flow model for Bank of America. Then we can also look at the relative valuation, and by getting the two, we can combine them and make the intrinsic value. What is the DCF model? Well, the DCF method is estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on a selected operating model. Right now, Bank of America's price is sitting at $39.77, and when putting in a discounted rate at 8.2% and a terminal growth rate of negative 2.6%, we can see that Bank of America was valued at $39.10. When plugging in a discounted rate at 8% and a terminal growth rate at 0%, we can see that Bank of America was valued at $57.70, which is an undervaluation of 31%. And when plugging in a discounted rate at 7.6% with a terminal growth rate at plus 2.6%, we can see that Bank of America's best case scenario was being valued at $104.15, which would be a massive undervaluation at 62%. Relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics it uses include EV to revenue, EV to EBITDA, and PE ratios. There's many different metrics that you can use, and you can interchange them in and out, but these are the main three that I use when coming up with my relative valuations for a company. Bank of America's relative valuation when plugging in my numbers for the worst case scenario came out at being undervalued by 2%, being worth $40.39. On the base case scenario being worth $43.85, and the best case scenario being undervalued by 19%, being worth $45.93. Like I mentioned earlier, we can then get the intrinsic value by adding the two together and dividing by 2. So if we remember that the price of Bank of America is currently sitting at $37.77, the intrinsic value worst case scenario was an average of $39.75, just under their current price. We then had an average case at $50.76 and a best case at $76.54. Once I've got the intrinsic value, I'll then get one more valuation method, which is going to be the Wall Street estimates. The reason I get this is because I believe with having three values, that is going to give me the best average price for each worst, average and best case, and then I'm very happy and comfortable with my valuations. What is the Wall Street estimates? Well, it's an average estimate of a public company's quarterly earnings and revenues that leads to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. For companies the size of Bank of America, there's going to be multiple analysts looking at this company on a daily basis and coming up with the numbers. On the worst case scenario, on their 1 year price targets, they have it being valued at $39.39, which is a 1% downside. On an average case scenario, they believe it will be worth $46.83, which is an 18% upside. And a best case scenario being worth $54.60, being a 37% upside. Now that I have all three valuations, I can combine them and get my final best, average and worst case scenarios. On the worst case scenario, Bank of America is being valued at $39.62. So if we were to use a 10% margin of safety on this price, we'd be looking to buy around $35.66. And with a 20% margin of safety on the worst case price, we'd be looking to buy at $31.70. On the average case price, they were valued at $49.46. So with a 10% margin of safety, you'd be looking to buy at $44.51. And with a 20% margin of safety, you'd be looking to buy at $39.56. And with the best case scenario, we can see that it was valued at $69.23. So with a 10% margin of safety on the best case price, you'd be looking to buy at $62.31. And with a 20% margin of safety on the best case price, you would be looking to buy at $55.39. So what does this mean for Bank of America? Is it a buy right now? I think the Bank of America is showing some really promising signs with their strong share buyback program and continued healthy dividend hikes where they've promised to increase it by 8% per year. This is going to be a very, very attractive sign for a dividend investor that is looking to buy into a great company and have it in your portfolio. They've also been performing very well over the last 12 months, being up nearly 40%, which is to no surprise when their revenue growth has been up 6% year on year and they have assets worth over $3.3 trillion. Recently, Warren Buffett has actually sold a very big portion of his Bank of America stocks and has actually continued to sell throughout the last couple of months. Does this mean that Bank of America stock is a sell right now because Warren Buffett is doing so? One major reason is due to corporation taxes going back up. Corporation tax rates were lowered from 35% to 21% as part of the 2017 Tax Cuts and Jobs Acts. Those tax cuts, however, are set to revert back to their old rates unless Congress intervenes. So it looks likely that the tax rates are going to go back to where they were, which means that people like Warren Buffett are trying their best to avoid these taxes. And for someone like him, it looked like he had to sell out of this position. Not only has he sold out of his Bank of America position, but he's recently trimmed out of his Apple position as well. This was also due to the potential tax rates being increased again, but also the fact that he was realizing the gains in the position that he had as he was up a considerable amount, not only on his Apple position, but also his Bank of America position. Now, we need to bear in mind that the percentage of his portfolio that is still of Bank of America is 11.7%. So it's a massive part of his portfolio and is still his second largest position in the portfolio, even after trimming down. Yes, there might be people like Warren Buffett selling out. Does that mean that it's a panic sell right now and definitely not a buy? You've saw all the strong fundamentals that Bank of America currently has, and I have showed you that today, and it's not always the case. People like Warren Buffett we can't always relate to because he's got, a lot more money than we have, and it's a very, very different ball game up at the top like that. Is Bank of America stock one that you're going to look to add into your portfolio right now? Do you currently already own Bank of America, and have you been adding into your position, or are you following Warren Buffett and selling out of that position? Let me know in the comment section down below. I hope you enjoyed today's video. Please let me know of any future stocks that you want to see get an analysis on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.